Why is leverage so important in derivatives market beginnings? Imagine being able to control a large amount of assets with only a small amount of money. That's what leverage offers in the world of finance. It might sound simple, but it played a huge role in how derivatives markets started and grew. When traders, investors, and institutions wanted to manage risks or make profits, they needed a way to amplify their positions without needing all the cash upfront. Leverage made that possible. Early derivatives like options and futures inherently provided leverage because they only required a fraction of the total asset's value as collateral. For example, buying an option might only cost a small percentage of the underlying asset's price, but it gave the holder exposure to the full value. This meant traders could potentially make bigger gains if the market moved in their favor. It also made derivatives attractive tools for hedging against risks in volatile markets, like sudden changes in stock prices, interest rates, or currency values. During the 1970s and 1980s, derivatives markets expanded rapidly. This was a time when markets became more unpredictable, and investors looked for ways to protect themselves or profit from these swings. Leverage allowed them to do both. When markets moved favorably, leverage magnified gains, encouraging more people to participate. This increased trading volume and liquidity, which helped the markets grow even faster. But leverage is a double-edged sword. While it can boost profits, it can also lead to big losses. If the market moves against a trader's position, the small initial investment can quickly be wiped out. This risk of rapid losses pushed regulators to develop rules and safeguards to prevent excessive use of leverage. Financial institutions also used leverage to transfer risk or free up capital. For instance, credit default swaps, a type of derivative, allowed banks to shift credit risks to other parties. This meant they didn't have to hold as much capital against potential losses, freeing resources for other investments or loans. Technological advances and new pricing models like the Black-Scholes formula in the early 1970s made valuing options more accurate. This encouraged wider use of derivatives and their leverage potential. The combination of these innovations and leverage fueled the rapid growth of derivatives markets, shaping how they operate today. In essence, leverage was vital in the early days because it allowed market participants to gain large exposure with limited capital. It made derivatives more appealing for hedging and speculation, which in turn helped these markets expand. However, it also introduced risks that have influenced how markets are regulated and managed over time.